Okay. So, time to start. Okay. Actually, I will do two presentations, but the second one will be very short. The main focus of my presentation, of course, is the discussion about the joint estimation of market and credit risk in cryptocurrencies. You know, my last 2 years were devoted to to risk management with cryptocurrencies, because really, for me, unfortunately, this is a topic that really is, I don't say that is almost absent. Of course, yesterday was a beautiful presentation, my colleague for the Russian Central Bank, that discussing, there is now also the BIS document that try to introduce some metrics, some measure, because really I understand the passion to introduce some new application with the blockchain, whatever you like it, but risk management is fundamental. You cannot really throw money without a minimum of risk management. Really, this is a crazy time. Really, my main stimulus came when in December 2017, when there was the peak of the bubble, the previous bubble of cryptos, people were taking loans, hypotheca, loans, to buy cryptocurrencies. For me, that is crazy. Imagine that you meet someone on the street, they say, I take a loan to buy lottery tickets. Okay, you can win with lottery ticket, but really you need some, really some limits. This for me was really crazy. So luckily in the last year there was a discussion about that, because really I was in the forum, really there was people crying because, you know, the Bitcoin price jumped to $20,000 in a matter, really there was really crazy moment. The price jumped up to $20,000 and then collapsed to 8,000 in basically in a matter of days. So people crying in the forum and trading for really, that really, so for me it was a crazy moment about that. So the question is, how can we define market and credit risk? Because, you know, while for standard assets, for standard financial assets, you know, particularly credit is quite clear. You know, I take a loan and then I don't satisfy my obligations. For cryptos, credit risk is not yet clear. In fact, actually, this is the first paper that tried to fix a little bit this concept. Actually, in the crypto world, there are actually two types of credit risk. And I want to, today I focus on one type of credit risk. So just to explain to you what is a credit risk for crypto. There are, one is the credit risk related to the exchange, okay? To the exchange where you buy your coins, your tokens, whatever. Because, you know, exchange open and close with the speed of lights in crypto worlds. And people really completely disregards that. Unfortunately, as I also discussed later, there are very, people are kind of used to the classical exchange, like for stocks, for futures, that there are insurances. No. If you put money in exchange and the administrator is a nasty guy, take the money, goes out, go to the Maldives and say goodbye to you, you have lost everything. There is no insurance, nothing protection. It's the wild, wild west. There is only some exception like Gemini, Coinbase, a couple of the main top ones that have some basic insurances. But apart from those limited, really, and this is quite crazy for me. So this is the risk of for exchanges. This is one important credit risk that I discuss a lot in my latest book that was published a couple of months ago, and it's a very, very important topic. Today, I focused on another type of credit risk, which is the risk that my coin, my token, from one day to the next one, completely lose values. Why? It happens immediately. There are many reasons. Because they found a bug in the code? Because it was a scam. There are many scams. Because it was hacked. There are many possible reasons. So from one day to another, the value of the coin collapsed. Okay? Goes to zero. There is no more trading or almost close to zero. This happened quite openly. Of course, apart from the top ones, the top 10 cryptos, this is quite happened openly, frequently, this phenomenon. How to model this? Because basically, from one to another, basically you find yourself without any money, any coins of any value. So my idea was to build a model that is able to jointly and simultaneously model market risk, the classical variation in the crypto prices, and credit risk to estimate the probability of a coin death. This is what, for me, the credit risk. I go immediately to the point also because we are a little bit delayed. So for me, the probability of credit in this case is the probability of a coin death. The probability that the coin, the token, lose completely its value from one day to another. For many reasons, I told you, for a scam, a hack, because there was a bug in the code, whatever the reason, okay? So it's a slightly different situation from the classical credit risk that we have in traditional market, where basically we have an obligation and the counterparty fails to satisfy the this obligation. Okay. So how can we do that? Before that, I want to present this table that the editor of the Journal of Business Economics, where I published this paper, liked it a lot, where basically I compare market risk and credit risk between cryptos and traditional assets, okay? So let's start with the market risk and also differentiate with traditional finance. So basically, market risk are gain and losses on the value of a position of or portfolio of a live cryptocurrencies that take place due to the movements in market prices of cryptos in centralized or decentralized exchanges. By the way, this definition, probably some of you that work in central banking or risk management places, is very, very close to the classical definition of the Bank of International Settlement for market risk of traditional assets. If you take the BIS document, it's quite close to that. What's actually the difference with traditional finance between cryptos and, well, unfortunately, given that the vast majority of exchanges are unregulated, are completely regulated, what do we have? We have a lot of market manipulations, a lot. Classical pump and dump schemes. I don't know if you have this term, pump and dump schemes. Pump and dump schemes, I told for anyone maybe that is not, okay, you should know it, but people that doesn't work in financial market may not know it. Pump and dump scheme is the following, fraud, is a fraud, Abman, fraud. Basically, I put out the news in forums, online, on the social media, that these coins, like their Fantazzini coin, is a new coin, the future. There is a new, very interesting application, really very cool. So there is an interest. People look for their Fantazzini coin. Wow, it seems that Warren Buffett has invested in this coin. Cool. So there is a lot of likes, applications, so a lot of news in the social media, a lot. What happened? That the price of the Fantazzini coin increases a lot, a lot. Well, so the news on the social media increases, the price increases many, many times, also 1,000%, because it's usually 0.0001 to $1, can imagine. After some days, I take all this money and I sell, I'm the main investor, I sell it and I fly to Maldives and I say to you goodbye, okay? So this is a classical pump and dump. These are very famous in the classical stock in the 30s. There are beautiful books written about this kind of frauds in the American markets, many in the past century. In the cryptos, this is common frequently. It's not this is frequent phenomenon. There are many papers that analyze it. And this happens, also on Bitcoin. On Bitcoin, the king of cryptos. There are a beautiful paper published by a group of MIT professors, just published, that show that many episodes of pump and dump on Bitcoin, not on the latest, on the Dean Fantazzini coin, on Bitcoin. That is common. So this creates also a lot of problems of the very different prices between exchanges. Okay, so a lot of frauds. For example, if you see the price of Bitcoin on different exchanges, you can see very huge differences. In some cases, it can be up to 10%. If you think about classical market, difference of 10% is impossible. In Bitcoin, it's possible because unfortunately there is this risk, this kind of frauds. Okay. Also, differences from traditional finance. Cryptocurrency exchange, I told you, do not provide neither cash nor asset insurances. There are exceptions, luckily. Gemini, Coinbase, and others provide at least for cash some minimum insurances. Okay? Or credit risk. Credit risk are the gain and losses on the value of a position, or a portfolio of a dead cryptocurrency that is abandoned or considered dead according to professional and academic criteria. The question is, how can I consider a coin dead? It's 1 trillion question, I would say. There is no unique answer. In my paper on the Journal of Business and Industrial Economics, I reported all these criteria. There are at least 3 from the top criteria, but they are quite different. There is one which is used by some funds that consider that a coin that has a value less than 1 cent of a dollar. Less than 1 cent of a dollar. This is one. This is by professional. It's a professional criteria. Another criteria used by professional consider 4 factors. That is no trading volume, no GitHub updates. GitHub is a website that collects update on the code of the coins and whatever. No social media, and the 4th I don't remember right now. So there are 4 criteria that have to be satisfied. If these 4 criteria are satisfied, the coin is considered dead. These are the 2 main professional criteria for dead coins. The 3rd criteria is academic. Actually, for now, it's the only academic criteria. Was published by Feder, Moore, and other 2 MIT professors, UCLA and MIT. In this ACM proceedings, is one of the top proceeding conferences series for IT especially in the US, where basically it's a quite complex, it's an algorithm. Basically, they compute an average of the trading volume in the last 30 days and last 7 days, and then they find the peak price volume, the peak volume, and basically compute these algorithms that tells you if the coin is dead or not. So it's a purely mathematical algorithm. So, as you may understand, it's not easy to understand if a coin is dead or not. Currently, there are 2 websites that try to keep track of these dead coins. One probably is the most famous right now, and it's called deadcoin.com. Deadcoin.com has over now more than 1,000 dead coins listed. Okay? This is one. Actually, it's probably the larger database. Also, there is a description why the coin is considered dead, for scam, fraud, hacking, lack of interest, whatever. There is another website which is coinopsy.com, which is a little bit more rigorous, more strict in the criteria. Actually, they use these 4 criteria factors that I told you before: no GitHub, no social media, no trading volume, and the 4th that unfortunately I forgot. And they also present a list of dead coins, okay, with explanation and so forth. So this is for the debt coins. Also, differences from traditional credit risk. This is quite fundamental because there are quite important differences between a debt coin and a bankrupt company. Quite a big difference. Probably the most important, debt coin can be revamped, can come back to life often, very quickly, very, very quickly. You know, if a company is bankrupt, you know, unless it's a very big company which has social importance, you know, a very important company because it has many job places, it's difficult that a bankrupt company come back to life. Probably in Italy, the most important example that I can remember is Parmalat. Parmalat was the biggest European bankruptcy. European, not worldwide, European, in 2003. But it was restructured because, you know, it has a huge number of job places worldwide, especially in Italy. And then it started with a new life, smaller, but usually starting a new company out of the bankruptcy is quite not so very home. It takes time, difficult, a lot of money, so it's difficult. Debt coins can be revamped, come back to life quite quickly. Why? Because what happened? Imagine that you find that your project, your idea, there was a bug in the code. So the previous group lost interest and went away because didn't have enough resources and stopped the project. Dead. After maybe some months, a different group, what happened? They go on GitHub, they download the code, they solve the issues, and they start again. So the money involved to start a new project are much smaller. So really, a dead coin can come back, can resurrect, let's say, come back to life many times. In this beautiful paper by Fader, Moore, and other MIT professor that I told you 5 minutes ago, they analyze the 2,000 crypto assets currently traded and find that a dead coin can die and resurrect up to 5 times in 5 years. 5 times, several times. So, and this is a find for, they find an empirical distribution of the possible case. So, it's not, so a dead coin is not the end of the story because, you know, the capital involved usually are much more limited. So to restart the project is much, much more easier. Okay? So this creates a kind of, mathematically speaking, a much more difficult issue to model this kind of credit risk. You know, credit risk, imagine Enron, Lehman Brothers, go to zero, goodbye, okay? There is no, it's the end, okay? Here instead, can come back many times. Also, another very important difference is, this is a specific question that I have to ask from the editor of the journal. Because he asked me, what is the relation between a dead coin and zombie firms? You know, zombie firms, a zombie firm is a company basically who makes enough profits to pay the interests on the debt, but has no enough profit and cash flow to pay back the principal of the debt. Okay, so you only pay the interest. The most famous example are the Japanese zombie firms, the classical. In the economic literature in the last 10 years, there was a lot of papers about zombie firms. Probably the most famous is the paper by Caballero, 2008, American Economic Review, about zombie firms, the effect on the economy. So it's a very, very famous paper. In the last 2 years, there were 2 beautiful papers also. So there's quite a lot of literature. So the editor asked me, what is the relation between a dead coin and zombie firms? Well, there's quite a lot of difference because, you know, a zombie firms is a company that usually is kept alive in order to save job places, to avoid a crash, a kind of chain reaction, but basically to save job places. This is the main reason, okay? A dead comp is basically, in a simple words, a project that for now, for the moment, has stopped working, okay? So, it may be dead forever, but it may be resurrected, can come back next year because a new group of programmers work it out, okay? Also, another very important difference between traditional credit risk and credit risk with cryptos. There are many here that have done traditional credit risk. In traditional credit risk, you can hedge this kind of risk with the use of derivatives, bonds, and stuff like that. Plus, also, in traditional credit risk, we have accounting data. So there are a lot of more information. In cryptos, we don't have derivatives, or very few. Basically, the first future on Bitcoin was introduced in the CME in December 2017, but apart from that, there is no official, I say, with a serious exchange. Yes, there are a couple of online exchanges that sell options on derivative, but really, I will never advise anyone to buy option right now on cryptos. It's extremely dangerous. Like, if you try to do that, basically you are doing like a monkey with a grenade, really. It's absolutely not thing to do because these options are completely illiquid in very few. So the only derivative that I advise you to consider is the future on Bitcoin, on the Chicago Mercantile Exchange. All the other is bad thing, avoid, really, if you don't want to lose money. Also, for cryptos, there is no accounting data. In cryptos, the only accounting, is not accounting, but the only accounting data is the white paper. What is the white paper? The white paper, for those who doesn't know, is kind of is a publication, free publication that describe what this coin token is gonna do. That's it. There is no other information. So you understand that really the data, the information available for traditional credit risk and data available for crypto are completely different. So the question is, how can, in such a situation, compute the probability of death of a coin? Given that I have no derivatives, no accounting data, nothing. The only thing that I have in the crypto world is the exchange price, the market price. That's it. The only information that you have. Okay, you have the white paper, but really, if you talk with a friend on the street, you have more information most of the time. Okay, so what can we do? I try to build, basically, I tell you the idea, a model that, a multivariate model that want to model the dynamics of asset returns, the classical multivariate model like the dynamic conditional correlation models or other multivariate model, and at the same time, I want to compute the probability of death. But how can I compute the probability of death now? And here comes into play this new probability, the zero price probability. I use the zero price probability to compute the probability of death, the probability of default, let's say, of a coin. What is the probability, the zero price probability? Zero probability is a tool that I introduced in probably one of my favorite and most famous paper in computational economics in 2008. Is a probability that is computed with market prices in order to compute the probability of default of a company, of a traded company, using only market prices. It was used, I published in 2008 in computational economics in order to provide a method to compute the probability of default using only market prices. Why? Because, I didn't want to use any accounting data because, accounting data can be full of frauds, okay? I'm a son of an officer of the financial police that all of his life worked to check balance sheets, okay? I can tell you a lot of stories of frauds, of traded company and not traded company. In simple words, I don't care, I don't trust accounting data. I see what they can do. So in this paper, I propose this method in order to use only market prices. Of course, market prices are not the truth, but at least they have some insider information. Okay, for example, if you take the two most biggest European bankruptcy, Parmalat and Syrio both are in the food sector, both were frauds that lasted for more than 10 years. Okay, the management of Parmalat take out regular money from the free cash flows of Parmalat and bought see, I know the words in Russian, Scartini, he bought Rembrandt, he bought Raffaello stuff and brought them to some safe place in London and in South America. So these are fraud that last for a very long time. So in this case, looking at accounting data will not help you. You need a way to try to extract some insider information. And for that, you have to use market prices, where there is at least some insider information. The zero price probability tries to compute the probability of default using these market prices. Mathematically, is the probability that the market price will touch the zero barrier. You know, the zero barrier, mathematically speaking, is called the absorbing barrier. It's a barrier level that absorbs the market price, after which we have default, okay? If some of you have done option pricing, this is a classical case for pricing barrier option, okay? The zero price probability want to compute probability that the price touch the zero barrier, okay? Because if it touches the zero barrier, we have a default, we have a bankruptcy. I use this concept from traditional finance, actually there are a lot of work in this case, in order to compute the probability of death of a coin. The probability that coin will die, and when it will die, when it will touch the zero price, okay? Again, the idea is that inside the market prices, there are at least some inside information. So they know that there is a fraud, there is a potential hack, there is whatever reason the coin may die. Okay? This probability of death can be computed using simulation methods. There are many ways depending on the assumption that you do. In the paper that I propose several ways to do it, with simulation or with closed formula. I propose, for example, a closed formula supposing that the market pricing of cryptos follow normal distribution. I'm the first to say that the market price of crypto do not follow the normal distribution. I know, absolutely. Most of the time they follow, they have brutal leptokurtosis, but I use the normal distribution because in case of normality, I can find out a closed formula. Why? Because using a result of Siu and Riegel, actually it's order results, it's possible to show that the probability that the price, that the stopping time will be before the maturity is 2 times the probability that the crypto price will be below the barrier at the maturity. So using this classical formula, we can find some closed formula. I don't want to really to scare you with this formula, just is a thing that I show in the paper. Really, I don't want to lose time because really I want to give you the idea that in case of normal distributed error, I can find the probability of death, the probability of default in a closed formula, okay? It may be underestimated, of course, but at least can be quickly estimated. Let's go immediately to the empirical analysis. So for market risk, I use this kind of multivariate models. The DCC with multivariate normal, the DCC with the student multivariate T, or the coppola gauge with normal coppola, or coppola gauge with student T coppola. These are classical models for multivariate distribution, okay? I use this to compute both the market risk and the probability of death using the zero prime probability. Also, as a benchmark, as a comparison, alternative competitive method for credit risk, I use this also. I use the zero price probability computed with univariate ARMA gauge. I use the ZPP with a random walk model in closed formula. I use the logit, the probit, and the random forest with several trees, not two. There is a typo actually with 2,000 trees. Sorry, it was a typo. Okay, so the logit and probit are classical models for credit risk. What kind of input I use for logit and probit? I use the trading volume in the last month, in the last year. I use in Google Trend and Wikipedia searches in order to understand the dynamic of potential speculation demand. So I use several factors in order to compute the probability of a coin death. So 1, the coin is dead. 0, the coin is alive. Random forest is probably one of the most famous machine learning methods. Of course, there are many others. I use the random forest because it's a classical benchmark from machine learning. There are many others, of course. But I take this because it's a good benchmark, okay? So, what we found, what we did, we consider actually 3 cases. By the way, we consider for this paper the case of small to medium portfolio. Small to medium portfolio. So why only small and medium? Because if we have to model large portfolio with hundreds of assets, the model should be different. Okay, so we consider a classical case of a top 5 cryptocurrency. We consider a portfolio with top 5, random average, and junk cryptocurrency. Junk cryptocurrency are currency that are gonna be dead. For probability of deaths, we use a case of 42 coins, where 29 were alive in the training period and 13 dies in this training and validation periods. A couple of comments about this. You know, I work a lot with traditional credit risk, and you know, I'm really the first one to tell you that a credit risk empirical analysis with 42 assets is almost ridiculous. I told you, I work with a lot of credit risk in Italy and Germany. To have a robust credit risk system, especially with small and medium companies, you need, you know how many companies you need? At least 50,000 companies. 50,000 companies. Any estimate who has less than that is extremely, maybe extremely unreliable. So I already stopped your question. I know 42 is almost funny to say. What is the problem with cryptos? That unfortunately it's very difficult to find market prices for the majority of dead coins, okay? I'm trying now to look also with a colleague, which is a professor in Scotland, to try to implement, this is actually future research I plan to do, the algorithm that was proposed by Furthermore and the other group of MIT researchers, MIT specialists, in order to try to identify dead coins that are also present in a famous website. It's called coinmarketcap.com, which is one of the main websites which has historical prices, coinmarketcap.com. Because if we are able to find also there for additional dead coin with this algorithm, we can enlarge our data set. I'm really sorry about that, but really when we started with analysis with Zimin, this is my previous student that now works in coin startup, by the way, was find that coin, the historical price of that coin was very, very difficult, okay? And by the way, the situation is even more difficult if we analyze credit risk of exchanges. Because for market price of coins, maybe somewhere you can find the historical prices, maybe. But for exchanges, when exchange close, it's a disaster. It's difficult to find that. So, at least for coins, we have some issues. How much time do I have left? 10 minutes. Okay, I go immediately to the result because I want to discuss about other things. I want to For curiosity, then I'll discuss the results. So this is the correlation matrix of the training sample that we use for doing our training of the multivariate models. That was June 2016 and May 2017. This is the correlation heat map of all the coins in the validation sample, in the out of sample validation sample. This is June 2007, May 2018. Here you see that the correlation is much lower than during these prices. Here in this case is when the bubble of crypto collapsed. So there was a brutal increase in the correlation. As you see, the correlation is extremely high, almost higher than 50%. This is important because what we found in our backtesting analysis that while in this training sample, classical multivariate model actually did not perform very good compared to logit, probit, random forest, or simple univariate models for credit risk. In the out-of-sample validation, the multivariate model were much, much closer to the classical logit, probit, and random forest. And the reason is here, that during the crash, the dependence of the cryptos increased brutally, okay? So, given that during a crash, the dependence between assets increased brutally, if you model this dependence, you have an advantage. You have much more precise estimate of the probability of death of a coin. So this also explains why the classical multivariate model didn't do very good in the training sample, but actually were quite competitive in the out of sample. Also, well, we found interesting result, only a couple of things. So this is a out of sample back testing for the value at risk. For back testing, we use the classic, for market risk, we use the value at risk. Value at risk is the quantile of distribution. What we found with different models, that actually all estimates actually were quite aggressive. You see, for the 1% level, almost all models, particularly for large portfolio, were very brutal, very extremely aggressive, 3, 4, 5% instead of 1%. And of course, if you do the classical test like the Kupiec, the Christofferson test on the value at risk, they reject. They say that your estimate is not very good. So we try different methods. So why we have such a bad thing, really? And particularly the larger the portfolio, the most horrible are the estimates. So we said, okay, this is in the out of sample when there was the market crash. We on purpose choose a market crash as an out of sample in order to really to back test with the brutal situation when the Bitcoin crashed from 20,000 to 7,000 in a matter of days. And you see that the classical model failed brutally. So we said, okay, there is a brutal dependence. What we can do? Let's use comonotonic, the hypothesis of comonotonic assets. What is comonotonic assets? Comonotonic assets is the case when the variables are perfect, positive dependent. Perfect, positively dependent, okay? When we have a comonotonic asset, the multivariate dependence is modeled by the so-called comonotonic copula. The perfect positive dependence copula. Okay? What does it mean in simple terms that our assets are comonotonic? Means that the variation of all the assets depend on a single factor. In case of comonotonic assets, all the dependence is explained by one factor. And what is this factor? The Bitcoin price. So if you use the hypothesis of comonotonic asset, you see we have amazingly perfect estimates. VAR 1%, empirical VAR close to 1%. VAR 2% close to 2%. 5% close to 5%. And in fact, the classical tests for the value at risk do not reject that we have good estimates. Okay? So summarizing, So we define for the first time in the academic literature what is credit and market risk for cryptocurrencies. And we propose a set of models to estimate jointly. Also, we propose to close formula for the zero price probability in case of normal distributed error. We found that usually T coupler with QT gauge marginal are quite good for value at risk estimate, which is a classical estimate market risk in the extreme quantile. Okay. And also particularly if you want to test the expected shortfall. The expected shortfall is the average of losses in the tail of distribution. Also, we did tests for the expected shortfall and found that the QT gauge margin with the T coupler are usually the best for the most extreme expected shortfall. Also, we find out the classical credit scoring model performed quite well in the training samples, but the multivariate model were much better in the out of sample thanks to the much stronger dependence. Okay. Also, when we have portfolio of assets, actually found that only if you use comonotonic hypothesis, our portfolios manage to pass all the backtesting tests for the value at risk and the expected shortfalls. Also, another result that, unfortunately, due to time limits, I could not discuss much, is the estimation windows. We try also different estimation windows, and we find that an estimation windows of 500 daily observation is a good compromise between efficient estimates and structural break. You know, structural break take place also in classical finance and economics, but they are quite rare. They're quite rare. In crypto, structural break are the rule, are the norm, because you have change of regulation, hacking, people fly away, new tax regulation, police intervention that arrest or close exchange. So structural break is the rule. So you have this brutal variation. So how can I model? Well, in this case, I cannot use too long a data sample, because otherwise my estimate would do not have any more meaning. For example, if you take the price of Bitcoin up to 2011, I'm not sure that you have decent estimate, because you know the market of Bitcoin 2011 is ancient times to what is the market for Bitcoin now. So this is why 500 daily observation is a good compromise to have decent estimate of market and credit risk for coins. As I told you, we consider only small and medium sizes in order to have not so big model complexity, and also because unfortunately we didn't have data of dead coins, historically of dead coin. So, you know, there is a classical problem in finance which is known as survivor bias, survivorship bias. It's a classical problem of mutual funds and stuff like that. In that, for cryptos, it's even worse than that, because you know, in cryptos we have also 2,000 traded coins. We are able to find 13, 15. So I can, of course, try to estimate my model with 2,000 alive coins and 15 dead coins. But any estimate would not make any sense, because, you know, given that I don't have 800 dead coins and I only used 13, you can imagine that any estimate for any creditor would be biased. Okay, this is why I prefer to keep it simple, to have only 42 dead coins, to more balance, okay, between a live coin and dead coins. So the estimates are not plagued by survivorship bias, which is the main problem when we analyze credit risk for coins. Okay. Excuse me. Can you please the second slide? I finished in the last 2 minutes. I know that everyone is hungry. We want to have lunch. So I want to discuss really in the last 5 minutes, and also I want to thank Sergey for giving the opportunity to discuss my latest book that I published a couple of months ago, where I discussed this issue in much more details. Was published by Amazon. Okay, if you are curious, I have a copy here, just to have a look, where I discuss this in much more detail, much more calm. There is step-by-step example with art, so you can enjoy, have fun, and stuff like that. So what there is in this book? Actually, I use this book as for two reasons. First, organize all my material for 5-6 courses. In this book, basically, there is econometrics 3, time series analysis 1, 2, 3, risk management 1, 2, numerical method for finance 1, 2. And there is also the material that I prepared for the past edition of the Winter and Summer School in Blockchain Economics that took place in Perm. In fact, my interest in cryptocurrencies started with Sergey. So he is the culprit of my interest in cryptocurrencies, okay? So let's have an idea what there is. Actually, there are 3 parts. In the first part, we have a brief review of cryptocurrencies and Bitcoin. So I discuss what is cryptography, asymmetric, symmetric cryptography, hash functions, digital signature stuff. So people have an idea what is this. What is the SHA-256 cryptography and so on. Then, in the second chapter, I discuss how to download with our free, besplatna, Bitcoin and other cryptocurrencies data. From all available places like Bitcoinity, CryptoWatt, Kraken, CoinMarketCap, Poloniex, or using other packages like Crypto package by our Ruscoint package by my friend, and so on. By the way, while writing this book, I created 2 packages, our package that you can find on GitHub. You download from GitHub. In the third chapter, I used the third chapter as a general review of liquidity measure. Also was a good occasion for me to review liquidity measure. I discussed there 31 liquidity measure. Basically, I used the famous survey basically as a reference of Ronaldo and von Vis, 2004. There is here you are from Lausanne. Ronaldo and von Vis are from or Lausanne or Bern. Where basically because defining liquidity is difficult. Goodhart, the former chairman of the Bank of England central bank, said that if you don't add many additional definitions, defining liquidity is almost impossible. So I discuss almost all possible liquidity measures like volume, time-related, and multidimensional liquidity measure. So there are 31. So basically, all the liquidity measures discussed in the literature, professional and academic. And how to compute, how to download wizard, downloading data, and stuff like that. Then chapter 4 discuss the evaluation of Bitcoin and cryptocurrencies. I basically, given that this is quite a large topic, I want to give an introduction and a general idea. I propose 2 classes of models. One class of model for value in cryptos is market sizing. I don't know if you met market sizing in your studies of finance, stuff like that. Market sizing, to be short, is an approach very, very famous, very old actually, to try to value a company based on its future market for this product and how the percentage that the future company will take of this new future market. So for example, I want to make new comments for slides. What is the future market for this stuff and how percentage of this market I will take as a company? Market sizing try to do that. Let's say all the latest models are basically extension of the market sizing, okay? Like also, for example, the ENET model proposed by Chris Burdinsky in his famous book, Crypto Assets, and stuff like that. So, and actually, if you have a company and you talk, you are evaluated with this one. This is one. The second class of model, instead, are more for short term, particularly for traders, and are based on the marginal cost of production. Okay, inefficient market, we know for macroeconomics, marginal cost should be equal to marginal profit. Okay, so the price should be the one that make the marginal cost and profit equal. This class of model try to find the optimal price using this marginal cost of production, which in all cryptocurrency depends on the electricity cost. on the electricity cost. Okay? In the fifth chapter, I describe price discovery. There are several methods. Here I use the classical price discovery by De Jong, which actually based on Harvey 1989, which try to understand from which market the market price signal is coming for. So imagine if you have many markets, like in cryptos, the market signal may come from different sources. Okay? Second part. The second part, basically, I describe traditional univariate and multivariate models for the price series and for volatility. Probably the most interesting, at least I have the most feedback, was the chapter 8, which probably the first test discussion at the textbook level of model for financial bubbles. Okay. In chapter 8, basically I present 4 methods to identify financial bubbles. Sorry, 5 methods. Actually, there are 2 methods that can be basically identify a single bubble, a single phenomenon of price explosions. Other 3 approaches instead are more general and try to identify possible potential many bubbles, because you know a market can show many bubbles, not only one, and also is more robust. Okay, also because it is known from econometrics from 20 years ago that a market price that show many bubbles and then collapse can be found stationary when it is not stationary, but actually is a series of non-stationary bubble exploding. So this is why it's important to have a test that is able to consider the presence of possible many bubbles. Actually, it's a multidisciplinary chapter because this method comes from economics, econophysics, theoretical mathematics, and IT. So there are different backgrounds. I present all of them because I think if you work with cryptos, you should know all of them. Okay? The last part, I would say that really is the core, the heart, the serce in Russian, of the book. Okay? Because this is a risk management. I told you, my main work is about risk management. So first is market risk management. Okay? So I discuss the main measure of market risk, like the value at risk, expected shortfall, how to backtest the value at risk, the expected shortfall, and so on. Then we do portfolio management. So I refresh the classical Markowitz approach, and then I move on to more better approaches, like the mean expected shortfall, the mean conditional drawdown at risk, so which are better. Also, plus other more recent approaches like the minimax, the omega, and so on. The last chapter is about credit risk, where we have credit risk for crypto exchanges and credit risk for dead coins. So I discuss several methods to compute the probability that an exchange will close. So I use the classical rating methods because, for example, there is a service which is called DG Economist, which offers a so-called a tool in order to build a kind of a rating for your crypto system. And actually, it can be applied to all possible type of firms who work in the crypto world, like mining firms, coin token, producer of software, so any possible firm related to the crypto world. And it's good because it gives you an idea how to build the rating. So the idea is similar to what Standard & Poor's, Moody's, Fitch do. This one, plus method to compute the credit risk using credit scoring, using panel method, using Bayesian methods, using machine learning and stuff like that. Also, the last part of the chapter about credit risk discuss how to compute the probability of deaths of crypto coins and how to test, to backtest. So the classical backtest measure like the receiving operator curve, ROC, receiving operator curve, ROC, which is the main tool that you have to use to backtest the probability of default. When you have 2 cases, bankrupt, non-bankrupt, alive, death, okay? So the classical measures to backtest the credit risk. And of course, some conclusion with the challenges ahead. So to give you also an idea, just to feel, and then we go lunch. So, okay, this is the job. If I skip it, for example, I want to download the price of the Euro Bitcoin, the price and the volume from Bitstamp, hourly prices, in the last 30 days. So this is the command that I can do it. Okay, I use past zero in order to divide in 3 parts. Read the symbol, and this is the price. You see, beautifully every hour. Okay, real time. Okay, I really love it working with cryptos, because really with crypto you have the full order book in real time for free. Imagine if I have to do the same thing with classical assets, I have to ask for a grant, of several $1,000s to have the order book. Imagine to have the order book of a stock at the New York Exchange. I have to pay $10,000 maybe. Here we have the full order books in real time. So this is why it's very, very nice, I think. So if there are some students here, tomorrow for the bachelor and on Tuesday for the master, I will discuss these things. I also will show some example. For all the others, it's time for lunch, and thank you for the patience and for following me. Thank you.